So there's so many ways you can use the stock market, right, when you're trying to find out what's going on, particularly risk on or risk off tendencies. Now, my next guest, he's a Wall Street legend, and he suggests, get this, folks, he suggests that we measure, we take the Invesco S&P Pure Growth and measure that against Invesco's S&P 500 Pure Value. With me now, CFRA Chief Investment Strategist Sam Stovall. Sam, I did what you did, man, and to sort of paraphrase Drake, it was all good a week ago. I mean, what happened? You see behind me, we've got the chart. August has spiked, and it's been sort of in really retreat since then. What's the message?
Hey, Charles, good to talk to you. I think the message is that the market got a bit ahead of itself, especially from the growth side of the equation. Technology was trading at a 73% premium to its 20-year average forward PE ratio, the market itself at a greater than 40% premium. So I think investors are saying, you know what, we've squeezed a lot of the juice out of this lemon. Let's go look elsewhere, at least in the near term, and that's what they did.
So last week, of course, particularly before that reversal on Friday, everyone's thinking, okay, we're vulnerable. How far can we go down? You do mention, maybe a pullback could see us go down to maybe 6,200, 6,100. Explain why those could be the levels.
Sure. Well, I believe that whatever decline we experience is not going to be the start of a new bear market. If you look to all declines between 14 and 23%, which is put the most recent decline smack in the middle of those, we've had 16 of them since World War II, and the average decline was less than 9%. And that would bring us to a little below 6,300 on the S&P.
Okay.
But if we went even further, it would bring us down to about the 200-day moving average, which was at 61.25 as of last week.
Yeah, we had that on the chart over my shoulder here just a moment ago. Let's talk about then where we want to be invested on the pure value side. One name you like is Eversource Energy.
That's right. Well, this is a company that has a 5-star or strong buy recommendation by our analysts. It's currently trading at a 22% discount to the S&P 1500 electric utilities forward PE, and we think that there is an opportunity for multiple expansion in the near term. Also, the company's exit from the offshore wind area, as well as the pending sale of its water utility, we think will support a more simplified operating model.
What is Syncora? You always find these amazing names that I'd never heard of.
Well, I cheated a little bit. What I did was I looked up the constituents within the RPV, the value, pure value, and said which stocks have buy or strong buy recommendations, and our Lowry technical analysis arm has favorable recommendations, and this one popped up. It's a pharmaceutical distributor, which is doing quite well. One reason is they're not affected by the tariffs. Also, fewer regulatory risks than other areas within healthcare. And as you know, Charles, we are seeing an improvement in the healthcare space.
Yeah, less than 30 seconds. I know you also like Phillips 66. My question to you is, does it matter if oil just keeps moving sideways?
Not necessarily. We did raise it most recently to buy from hold, primarily an uptick in refining. Right now, it's in the early stages of a refining earnings upcycle, and it's really what's called the crack spread, or the difference between the oil coming in and going out.
Gotcha. Sam, great stuff as always. Really appreciate you. And again, we learn something every single time you're on. Thank you.
Thank you, Charles.
All right.